Whoa. How fancy.
Wow. Fancy.
I can switch backgrounds. Switch backgrounds around. Look at all these backgrounds we've had. What? Oh, that's kind of cute. What? Capital gains. Okay, so it's been weird. Jason, how are you?
I am excellent. How are you?
I am excellent too. I think we're both a little stressed right now. We both are leaving town. We've got things going on. But this came up. So capital gains we're talking about. What was I going to say? Oh, I forgot to say, like last time we shared the fancy introduction that I made. We'll have to fix it because that one part where it says, did you recognize that last house? This is one of our episodes. But I wonder if people realize what house that is.
I wonder.
You know? It is a
great question.
Should we tell them? We should start doing giveaways or something. Get
Let's
more.
let them guess. Yeah, we need. Yeah, that's a good idea. I like that.
Get more views. So anyway, this topic. Hi guys, I'm Katie.
I'm Jason.
I'm the lender. Just kidding. I'm the realtor.
I do mortgages, home loans, lending.
Look at my blanket back there. It just looks askew.
Askew.
It looks askew. Not even taking care of my stuff here. There we go. Is that better? A little bit. All right. So the reason why we're talking about this is because we have some clients right now in this crazy ass market. And I have a client that's owned a house since 2005. And she asked me, we were talking, and she asked me, once I sell my house and I make the money or whatever, don't I have to sell it within a certain amount of time or I'll suffer capital gains? And I said, no, but I wanted to check with you for sure. So we're going to talk about this. Capital gains, what the heck are they? Is she going to suffer capital gains, Jason?
So tell me her specific situation.
So she's owned her house since 2005. This is a client that we're working with that's going to have to sell her house. And she is going to buy another one anyway. She had thought about buying it first, but it actually makes more sense to sell and buy even in this market. Mm-hmm. So she was thinking, I've owned the house since 2005. What if I just keep all that money? Do I have to buy another? She in her head, she was thinking, do I have to buy another house within 5 years?
No. So, and it's been her primary residence, right? At least the last 2 years, 2 out of 5?
She's lived there since 2005. But yes, why do you say 2 years?
So capital gains, okay. Whenever you're talking about your primary residence, there is a portion of the gain on the sale of your primary residence that you get to keep tax-free. So if you're single, it's $250,000. Married filing joint is $500,000. Okay, so as long as her capital gain on the sale of that house, it depends on how she files her taxes, is under one of those two numbers, she wouldn't have to pay capital gains on it.
So I think we need that dumbed down even a bit more. So it's this. I had found this. You can completely exclude up to $250,000 in gain from taxes if you're single, $500,000 if you're married. So she's single. So now, does that mean on the sale of the home, because her house will sell for $300,000 or more?
So what did she pay for it?
Like 140 something.
Okay, so you paid $140,000 for the asset. You can sell it for $350,000. Okay. So what is that? You have a $210,000 gain. That's a capital gain is what that is.
Okay.
But the thing that's important about your graphic there, if it were an investment property, that would be a different conversation. But it's a primary residence. And the way that the IRS looks at it is you had to have had it as your primary residence for the most recent 2 out of the last 5 years. And as long as that's the case, so 2 years is really the deal. If she's occupied as a primary residence for the last 2 years, then it falls under that exemption that you have there. And she would not pay tax on that deal because 210 is less than the 250.
Okay, so then I have a quick question on this. Don't want to throw you for a loop here. She's lived there a long time. So let's just say, because she just happens to be in an area that doesn't appreciate as much as these other areas, because some are appreciating $100,000 in a year. So I live in a house from 2005. I paid $150,000 for it. Now I can sell it for $600,000. Am I going to suffer capital gains?
Are you filing?
I've lived there the whole time. I've lived there the whole time.
Yep. So are you single or are you married filing joint?
Well, I don't. Ryan Reynolds won't get back to me, so I guess I'm single.
So So your deal was you sell it for 600 and you paid 150 for it. Is that right?
Let's just do even numbers. I paid 200 for it. I'm going to sell it for 600, and I've lived in it, a lot of years.
Okay, so you have $400,000 that you basically have a gain. Now you can write expenses off of that, okay, because you're going to pay real estate fees, all that type of stuff. But $250,000 of that will be tax free. The amount above that $250,000, you will pay capital gains on that.
And is that 15%?
It depends. That's such a good question. So capital gains are broken down into short and long-term gains is what they are. So if you're single, it depends on what your income is. And the capital gains tax rate, it's either 0%, 15%, or 20%. So it depends on what the rest of your income is. So let's just say that you're in now, Katie, you're kind of a big deal, okay?
Yeah.
So, you're making really good money. But if your income is between $40,001 and $441,450, then that long-term capital gains tax rate is 15%. So if you make less, if you make $40,000 or less, then even though you have a capital gain, your tax on it is 0.
Okay, so now this is good that we're talking because that's going to be most people. So if now say someone's owned their house 25 years and they're making let's just say they're going to make 600,000 on it, but they're retired. Now, does that income, is that 40,000 thing, is that part of it? Or because they're retired, are they protected?
So tell me what their income is. No, retirement doesn't change.
No, they don't have any income right now because they're retired, right? So I don't know. Tell me, what's a normal income for a retired person?
It depends. There are retired people who have pensions and Social Security that are making, well into the 6 figures in their retirement.
So that counts as your income?
It depends if it's taxable or not. Let's say that they invested in Roth IRAs and their distributions were out of Roths. That's non-taxable. Let's say that it's a traditional IRA or 401k. Their distributions are taxable. So it totally depends on whatever your taxable income is.
There is a lot of information so this is why it's confusing, I think, for home buyers. And even I'm learning, too, as a realtor, but there's a lot that you have to explain as a lender to people.
Yes.
So, because I had this on here, but you already talked about when you sell your house, capital gains can be up to 15%. But didn't you say there was a higher one too, or no?
I'm sorry, say that again. There's what?
Is there a higher amount, higher than 15?
So yes, on short-term capital gains, and it's completely different. So short-term is anything that you gain that is less than 1 year. So let's say that I bought the house, okay, let's say I bought the house in January, and I turned around and I flipped it.
Right.
And I sold it in May, okay? Then whatever your profit is, your capital gain, so to speak, will be taxed at your marginal tax rate, whatever that is. That can be anywhere between 10 and 37% right now. Depends on how much it is that you earn.
Wow, I'd hate to have 37%.
Mm-hmm.
Okay, so let's just go here then, because here's what's interesting. Somebody owns a house. They are moving somewhere else. Maybe they're going to buy. Maybe they're just going to rent because they're going to go live somewhere else but they want to hold on to this house. So they're going to rent it.
Mm-hmm.
Okay. Say they rent it for just a year. What capital gains are they going to suffer on that if they want to sell it?
It depends. And the answer to that question depends on whatever the basis of that property is at the time that you convert it to business property.
So what do you mean what the basis is?
Here's what that means. Whenever you put a property into service as an investment property with the IRS, you have to declare whatever the basis of that property is. So there's a value that you ascribe to it. So if you bought the house, we're going to use round numbers, for $100,000, you lived in it for 10 years, then you moved into a different house and you converted that to a rental property.
Right.
And at the time you made the conversion, the value of the property was $350,000. And I'm super simplifying, and you should definitely talk to your CPA.
Yes.
But just to conceptualize it, that $350,000 at that point becomes your basis. Okay. So let's say that you rent it out for 2 years and then you sell it for $400,000. Okay. So your basis of 350 is where you're going to begin to calculate your capital gains, because you declared the basis at 350. You originally paid 100. So that's your $250,000 there. The homestead exemption, which is technically what it's called, that's how you don't pay capital gains on that. But the difference between that 350 and that $400,000, that's your capital gain figure right there.
And then, so whatever that percentage is, you said, is what they.
So it depends. Yeah. So it completely and totally depends on what you declare your basis to be when you convert that property from personal to business.
Okay. So do you see why I use him all the time? Jason, I mean, listen, we've already done 12 minutes here. We could keep going. We're just touching the tip of the iceberg here.
Well, and here's the thing. This is the most important thing to remember. Okay. Finances, so many of us, the way that we kind of think about it is it's kind of like what WebMD has done to people self-diagnosing themselves. Yes. I mean, the other day I figured out I had some crazy rare disease, because I had something, and then I woke up the next day and I was fine. But what we do is there's information all over the place, and we're trying to figure out. And so what happens is we get these things in our head. It's so super common. Oh, I can't sell. I don't want to pay tax or whatever it is. Or I've heard about a 1031 exchange that gets me out of paying capital gains. No, it doesn't. It just defers the taxable liability. So there's so many of these different complexities. And here's the bottom line. You want the best advice? The best advice when it comes. Of
course. Wait a minute. Let me put you on the pedestal again here.
Oh, yes. Here's your best advice.
Best advice.
Best advice. Best practice. Ask somebody who knows. Ask somebody who vocationally does this for a living.
Yes.
And so it's good to have real estate agents who are in the know. Obviously, Katie is. It's good to have lenders in the know. But it's also really good to make sure that you have a fantastic CPA that you vet all of this stuff with, because they know your situation. They've been filing your taxes for years. They know what your AGI is. They know what your income is.
What's AGI?
Adjusted gross income.
Thank you. Too many acronyms. I can never keep up.
That's right. So, and that's the point, right? We don't even know what these things are, but they're super important. And so that's why instead of us making up our own mind, oh, I can't do that because this is ask questions.
Ding, 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 ding. That you hit it. You hit the nail on the head right there. I feel weird having you in that spot, so I just kind of move you because I'm always looking at you over here. But Jason, thank you. I mean, and okay, guys, people that are watching, the whole millions of people that are watching, this is why you need to find. So lenders don't typically find buyers for realtors. It's the opposite. Realtors bring people to the lender, okay? But this is why you have to find a realtor with an amazing lender who can explain this stuff, because this is what I always do, Jason. And I tell people, well, if they have someone else, I'm like, just talk to my guy. You don't have to use them, because this is a wealth of knowledge right here. Like, we've been working together now, 5 years?
Oh, something like that.
This is my 5th year. So maybe not right away, 4.5, maybe. I don't think I started working with you right away.
Yeah.
But no, I think it is 5 years now, because it was around this time when I first started at my old company. So, whoa.
Yeah.
How cool.
So I can tell you a story that is a perfect example of what we're talking about with taxes. It actually doesn't have to do with capital gains.
Can I just interrupt really quick? Have you seen Notting Hill?
No.
Okay, there's a British guy in there, and he says, and I have to say this because every time someone says I have to tell you a story, he says, in just a moment, I'll tell you a story that'll shrink your bowls to the size of raisins.
I can't promise that.
Well, yeah. We're good here. Okay, tell us the story.
So I was having a conversation with a client the other day who was considering an investment property purchase.
Okay.
And in the course of our dialogue, they were talking about how they were going to fund the down payment. And the thought process is that he had a stock portfolio, and he felt like he could cash out his stock portfolio And what he said to me was really kind of interesting. He said, I know I'll pay capital gains whenever I sell my stocks, but I figure that I'll make that back up by depreciating the investment property. So in his mind, he's looking at it and saying, I'm going to pay tax here, but I'm going to get a deduction over here.
Is that true?
And here's the reason why I'm really glad that he said that.
Yeah.
Because those are two completely and totally different tax schedules, okay? Capital gains are going to be expressed on a Schedule D that flows through to the 1040. Depreciation on a investment property is expressed on a Schedule E generally, and then it flows through to the 1040 unless you make too much money and you phase out of the ability to take a deduction on your Schedule E. So what this means in lay terms is that in his mind, he was saying, I'm going to have tax here, but I'll reduce it over here. The problem that he had is he made too much money to take the deduction. So if he had gone down the road the way that he thought that he was going to go, he'd be thinking, well, I won't really pay these taxes because I'll get this benefit here. The problem is he would have never gotten the benefit here, at least the way that he was filing his taxes, without making some changes. So there's some ways that you could potentially work around that. Instead of putting it on a Schedule E, you could file a partnership return, which is Form 1065. Then the loss flows through on a K1. Then you can deduct it. So again, so many different complexities. You can't just assume how it's going to work.
I need to get some graphics in here that are like bombs exploding and stuff. That's a lot of info for somebody like me.
It's crazy, right?
Yeah. But see, you guys, that's what's so important about talking about everything, every thought, every worry, everything that you are thinking about when buying or selling a home. Because if that guy hadn't mentioned that, and in his head he thought, I'm going to lose it here, gain it here, he's going to end up paying a lot more than he planned on in the long run, possibly.
Well, and here's the thing too, the corollary to that story, right?
Yeah.
Is I probably talked the client out of buying a home. I probably talked myself out of the ability to do a mortgage.
Yeah.
But I'll tell you this, what we did do is we built a relationship. We built somebody who knew that they could get good advice, that could be trusted, that would tell them, hey, listen, I know this is what you want to do, but it might not work the way that you think that it would. And again, I think that that's super, super important, that you have good advocates in your corner that are going to give you the best advice. And sometimes that advice might not be to make the purchase that you're thinking about making, right?
Well, and that's the thing. So there's a lot of people out there. I mean, one teacher sleeps with a student, so all teachers sleep with a student. One cop does something bad to someone, so now all cops are bad. That's not the truth. One lender does something that someone doesn't like, so all lenders are bad. One realtor lied, so now all realtors are bad. This is why it's important to really vet your realtor, vet your lender, because you want someone that's going to be in your back pocket. And the reason or have your back. And then how you're going to know that is by that, Jason, just by that. And so I'll do the same thing, especially in this market. Listen, I have someone call me and tell me they want to sell a house and they want to buy another one. I don't want to push a sale away, but I'm going to talk to them. I had 2 3-hour listing appointments in the last month because we went over everything. And it was like, okay, you might have to rent. You might have to rent like this. Let's try and see if you can buy it, blah, blah, blah. The best is to buy in this point, if in this market, even in this market, if you're going to sell, but we have to make sure that you're comfortable with that. And so if I spend 3 hours at a listing appointment, not getting paid for any of that stuff, and they're not going to sell right now because they're not comfortable, it's like you said, that's that relationship. Do you know what I mean? And these are people, one of them's a friend. Well, they're both friends of mine. This, clients from 4 years ago who used another lender then and have been getting emails from them. And guess who they're using now? And you built that relationship, Jason. So they really appreciate how much you've walked them through that. And so hopefully we've written a contract because their house is under contract. I assume this is rhetorical. What do you mean? I mean, we're just talking about examples. I mean, it is rhetorical, right, Jason?
Yeah.
I mean, we were talking about how this happens, but I mean, I have real clients, but I'm just not using their names right now.
Yes.
Well, Kelly is someone who's owned a house for a really long time, and she lives in Nevada. So, are those laws and stuff the same there? Those rules?
These are federal tax laws. So
Okay.
state tax law is going to differ depending on where you're going. For instance, Texas does not have, personal income tax. So, it's totally different. Arizona does. Listen, they're going to get their tax money one way or another. In Texas, they don't charge it personally, but they put it into property taxes. It happens.
Can you work?
What we're talking about very specifically is federal tax law.
Okay, thank you for clarifying that. So, can you work in Nevada if Kelly's ever has questions for you? Because
sure.
Sometimes she asks me questions. She did years ago, just based on friends of hers selling and stuff. So, can you work there?
Yeah, sure can. Licensed in Nevada.
Kelly, if you ever need advice, contact me. I'll get you in touch with this fella right here. Okay, so boy, this has been really good because I thought about this. What kind of home qualifies? And the answer here, tell me if there's anything to add or subtract. Any home that's your primary residence. It could be a single family home, a condo, a townhouse, or whatever. Not a tent, I'm assuming.
Not a tent.
Now, is land included in this? Land sale, like land alone?
Well, okay, not for the exemption because you generally don't live on land, right? So could land be your primary residence? No. Land can't be, your primary residence really.
Even if you put like a travel trailer on, it's not your primary residence.
That's a good question. That's one that I would ask my CPA. Don't know the answer to that.
Oh, ding, ding, ding. There you go. So did we go over this, like how to calculate your gains? Is it based on what you said, what you bought it for, what you're going to sell it for, and if it falls within that exemption?
Here's the thing. This is a very technical question here. And it's probably bigger than because there's a whole lot of things that go into it. First of all, if it's a primary residence, the exemption most of the time is going to cover it. But if it's an investment property, it depends on how much you've depreciated it. So you declare a value with the IRS, you take depreciation on it, that gets recaptured at sale. You have expenses, you pay real estate agents, you pay money to title companies. All of that is written off against the capital gain, right? So how do you calculate the capital gain? It depends. Depends on your situation.
I have an old joke about Depends undergarments, okay? And it was like, the reason why they're called Depends is because an old couple is like, honey, do you want to go to the movie? It depends. Do you want to go to dinner? It depends. Like, how are my undergarments going to hold myself together? So just think of these problems as your undergarments.
That's right.
Hold yourself together. Jason, is such good information. We could do 8,000 shows on this, I think. I mean, you are such a wealth of knowledge. Thanks for sharing all this stuff.
Yeah, happy to.
Is it time? Is it time for, are you ready? Weird in the news. Jason has the topic today, you guys. I don't even know what it is.
I have two of them. Let me see if I can share my screen.
Okay.
Now, what I want to do is I want to start off and I want to restore your faith in humanity. We live in a time of,
tell me if I should pop it up.
Is it popping up? Oh yeah, it's down there.
Can I pop it up or?
Yeah, you can pop it up.
We live in a time, okay, I'm loving this.
We live in a time where people are angry at each other. We fight over politics. We see the worst that's going on in the world. I saw this and I thought, this is what we need to share with people today. Let's restore a little faith in our brothers and sisters out there, because it's definitely weird in the news because it's definitely different. I don't know who would do it. A store owner returns a $1 million lottery ticket to a customer who threw it away.
Can you make that screen bigger? Can you make it as big as, probably not because you can't scroll. Keep talking.
Yeah.
So how did they know they threw it away? They just saw him throw it away?
So yeah, the owners of a Massachusetts store returned a $1 million lottery ticket to a customer who had thought that it was a losing ticket and asked for it to be thrown away. Leah Rose Fiega of Springfield claimed a $1 million prize, but she nearly missed out on the jackpot after confusing her diamond million scratch-off ticket for a losing one. Abhi Shah, who owns the Lucky Shop, scratched the ticket off while still inside the store and handed it back to Shah's mother, asking her to throw it away. The ticket was placed on a stack behind the counter where it remained for 10 days before Shah decided to scan the pile of supposed losing tickets. She discovered the ticket hadn't been completely scratched off and completed it to discover the $1 million prize. The customer was a regular, and the store owner handed back her $1 million ticket and changed her life. Why? Because she did the right thing. How about that?
That's insane. How many times? Well, first of all, how many times does the store owner, do you think, actually scratch it off? Tell me when you're ready for me to pop this one up. How many times does the store owner actually go, well, I'm just going to go ahead and finish scratching this off? And then I think, how many times have I thrown away a ticket that could have been a winner?
Now, do you remember, talking about movies, Katie, we're movie people.
Yeah.
Do you remember the classic Nick Cage hit that was about a waitress and a New York City cop?
Yeah.
He couldn't tip her, and he said, if we win the lottery, I'll split it with you. Do you remember that movie? Do you remember what it's called?
It Bridget Fonda and Nicolas Cage? I can't remember the name of it, though.
It Could Happen to You.
Yes. Yes.
Yes. Fantastic movie. If you're bored this weekend and don't know what to do, watch that movie.
Watch it again because I can't remember if he actually shared it or they got in a fight or whatever.
Yes.
But
Okay.
Go.
I have one more because why not, right? Anytime somebody is 111 years old, there's something that we should be asking them. How did you get, I can't even, it boggles my mind, 111 years old. So how is this Australian man getting to 111 years old? So they asked
1910, right? No, 19, what year would that be? 1910,
1910. Yeah, 1910 would be when he was born.
Wow.
This man, just so you know, this man has seen the First World War. He has seen the Great Depression, the Second World War, the Cold War, the War on Terror. This man has seen
television.
He has forgotten more than we've seen.
Flight to the Moon. Yeah, I mean, wow.
111 years. So his name is Dexter Kruger, 111 years old. Kruger told the Australian Broadcasting Corp in an interview at his nursing home what the secret to long life was. And he had said, listen to this, I quote, chicken brains. You know, chickens have a head, and in there, there's a brain. And they are delicious little things. Only one little bite. His secret to life is eating chicken brains.
Show his picture again really quick. If you're done with the...
See, he looks all angry because he hadn't had his chicken brains for the day. But that's his secret to a little bitty thing. And you just eat a chicken brain every day, and you go to, I mean, if that's not weird in the news, I don't know what is. Chicken brains.
What do you guys think of that? That's crazy. I don't want to eat chicken brains, but hey, he's adorable. I want my parents to live to at least 111, so maybe I'll start secretly sneaking chicken brains into their food.
How do you even do that? It's not like they sell them at the grocery. Like what? You go? I mean, you collect chickens and here you can have the breast and leg and thigh. I'm going to take the.
And they have little heads. They have little. Do you remember the story about that chicken years ago that was still alive after not having its head? And the guy kept it alive. It was like a year.
Really?
Yeah, I'm gonna look it up. We'll talk about that next time we do that. Well, it'll be a little while, but yeah, it had something to do with when they chopped the chicken's head off. Part of its brain and like the stem and whatever was there, so it was still technically alive. So I don't know how he fed it or whatever, but it was like a circus act or something. He would take it around and people would look at it. Like, honestly, I don't care if a chicken has its head or not. I mean, I do, poor chicken, but I don't need to like watch a headless chicken run around in a pen. You know what I mean?
That's one of the weirdest things I've ever heard. Now
to make money.
We have to look it up, Katie. We have to bring that to our viewers. That's high quality content there.
So and I think we're going to change Weird in the News to one current, one past. I think that's good, right? Or two or whatever. It's kind of fun. I should have been doing this on Canada with Katie. So I think, okay, we're at least going to take a break next week. I think we're going to take a 2-week break. Yeah?
2 weeks.
Jason's going to be out of town. I'm going to be out of town. So To all of our viewers, all of our millions of viewers, we're really sorry. But hopefully the content we've been using has been good and useful. And if you have questions, reach out to me or Jason.
We're here.
I still can't get it right. It's just insane. Jason, add something of positivity before we leave today and do our tagline. Tell us something positive. Oh, what is that? Oh, I was going to.
What do you think this is?
I love your socks. Are you taking socks to Mexico?
I waited to put my socks on today until right now. Because I love yours so much, I wanted to respect mine. So I've been barefoot this entire time.
Well, I'm wearing flip-flops. I should have brought socks out to put on for you as well. It's really not fair.
Now I'm sitting here in my little sockies.
I'm sorry to disappoint you. All right. I love your socks, Jason.
Love your socks, Kitty.
We love your socks, everybody else. We'll see you in a couple of weeks, okay?
We'll see you guys.
Love.